Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions.
Today is Monday, September 22nd. It's 11 a.m. on the East Coast. That's Dan, Nathan. I'm Guy Adami. So today is the 22nd of September, means next Monday is the 29th of September. Why do I bring that up? Because before September is even over, the football season in New York is effectively over, Dan, Nathan, as our teams are combined 0-6. It's just not pretty here in New York.
I was thinking about you yesterday because this goes back, I think, 4 years, maybe a little more ago. The Giants made a very controversial pick for a quarterback.
Daniel Jones.
And the controversy was about, wait a minute, has this guy actually played anybody in his 4 years at Duke University? Okay. He got a great education. I'm sure he's a smart guy. You know what I mean? Like, if this football thing didn't work out for him, that Duke graduate, that is a great diploma, right? So Here he is. Your Giants are 0-3. He goes to Indianapolis. He's playing for the Colts. Now, I just want to be really clear. You thought that this guy could be a great NFL quarterback. That's where I'm also going back. So now he is 3-0, and it looks like they are rocking and rolling.
Sixth pick in the 2019 draft, Daniel Jones. It is, what year is this? 2025. I always, it doesn't, it doesn't matter what I think, because I don't get paid to make personnel decisions in the league where they play for pay. What we are paid to do is talk about the stock market, and maybe people would say we should pay you not to talk about it, Swizzle, because you're always, you're always wrong. And here we are, we're just talking about it, Dan.
Come on.
The market's higher. Why?
Because it's open.
Because it's open. And again, you look at an S&P making new all-time highs yet again. You look at a mix that's actually a bit higher on the day. It appears as though right now the market's looking past every piece of good news is magnified 5x, and every piece of bad news is completely discounted. I think that's where we are.
Well, we'll put this in the show notes. I mean, CC wrote this up in our newsletter that went out last night. If you're not subscribed to it, please do.
Oh, by the way, stop.
What?
Do you see what's going on the bottom of the screen?
Oh, look, you see a little ticker there? A little ticker? That's from our friends at FactSet, by the way, at FactSet.
That's Jacob doing the scroll, man. And Wavy McFly saying, loving the tickers. You guys are fancy. Yeah, we are. Right. Anyway, sorry about that.
Couple things really quickly. So Guy Adami came in. Well, you don't get paid for this. And why would I pay you? Blah, blah. All right, we guys go in the chat. Guy is like way, way, way too hard on himself. I don't even know where that all comes from. I honestly don't agree with it. I'll let you say it because it's your mouth and your prerogatives to say whatever you want. You say Swizz is all this all the time. That's a bunch of bullshit. We know it. I just want to get that out of the way. All right. So let's talk about some stuff going on this week, Guy. Amanda put together a little bit of a calendar for us. And I think there's some stuff on a week that you just said we're 1 week left in the quarter. And you'd say to yourself, well, we're through earnings season. We've had all the big data. The Fed already did its thing, that sort of thing. So let's just talk. A bunch of Fed speakers today barking, saying that they don't see a lot of room for future cuts. I think that's interesting. It just goes to show some of this inflation data that we've been getting is a bit stickier, and that brings us all the way to Friday. We'll just bounce around a little bit, Guy. The Fed's most favored.
Yes, that's the PCE. Yeah.
So that's on Friday. So let's bookend this a little bit with some of the expectations as it relates to inflation and some of the speaking about that. Powell speaks tomorrow afternoon. I'm hard pressed to think that there's too much that has changed from mid last week. New home sales, I think could be interesting, especially when we'll take a look at the home builders and what's going on with yield. So there's some stuff going on here, Guy. And GDP, that was also something that's Thursday morning that Fed Chair Powell spoke to the fact that I was a little surprised that while 1.5% is the expectation for this year, that's down a lot from last year at 2.8%. So before we get into some of the individual names, anything that you want to kind of, tie in together as it relates to Fed speak and yields and inflation and the like?
Yeah, well, I agree on Jerome Powell tomorrow at 12:30. If you look, Musalem, I think, spoke today or is speaking today. He has said that he, I'm paraphrasing a little bit, but does not see the real avenue for further aggressive rate cuts. And I'm not giving it its just due, but I think he was a little bit hawkish. Obviously, Mirren on the bottom is the other end of the spectrum. I think he's playing to an audience of a couple of people, and he'll be the outlier. But PCE on Friday, I do think it's important, more so than GDP. I mean, what are you rooting for as a market participant right now? A good GDP or a soft GDP? I mean, it's stronger than expected GDP. The Fed's going to have to try to explain like how they're cutting into what still is, a decent economy with decent unemployment numbers. Now, I think they're trending the wrong way, but I think those are some of the questions they're going to have to answer.
Yeah, no doubt. And we'll hit some of the names on the earnings front because I think some of them are important. But, we got to talk about, and we spent some time, I think, last week. So let's put up a chart of the 10-year yield. And, we've been highlighting the fact that maybe yields selling off, into this Fed meeting last week where the CME Fed funds tracker had been implying a near certainty, right, of that 25 basis point cut. I know a lot of folks were like, well, maybe we'll get a jumbo. That was not even priced more than, I don't think, 15% at any point. So for a 50 basis point. And so you see this trending lower. And I think it's important to remember in just the spring, we had a 10-year yield at 4.6%, right?
Mm-hmm.
And so take out what happened in April, right? And so you saw this kind of steady, shift lower. It was a series of lower highs, lower lows. You see that flattening 200-day moving average guy. I think it's about 439 or something. So we briefly got below that 4%. What do you think if we were to head back 4.25, 430, or maybe we get as high as that 200-day moving average? What does that do to stocks? And obviously there's certain sectors that it has more of an impact on.
Yeah, I think we should talk about that. So I think what will happen if we start to see rates, move up to the levels that you just talked about, 435 to 440 in the 10-year. I think what you're going to see, I know what you're going to see from me. You're going to hear people like me talk about how it's a replay of what we saw last September, as again, rates basically went lower into the Fed announcement and then subsequently went higher in the aftermath of. By the way, if you want, we're going to talk about home builders, so I'll wait, but the same thing with home builders. They rallied into the Fed announcement last September, and then they fell, and then the same way they rallied into the expectations of a rate cut this September, and now they're seemingly giving it up. So as Carter will say, look, it's a pair of twos. The market has dealt with these levels now for the last couple of years. It's nothing we haven't seen before. But I think given the fact that the Fed cut rates and given the fact that there are 2 more rate cuts expected, if yields start to move higher in the way that I think that they will, I think you're going to have more and more people start to talk about the eerily reminiscent chart patterns or predictability of what we saw last fall and this fall.
Yeah, so let's pull up the S&P 500 for a second and just kind of take a look at just this kind of runaway sort of, I think there's been like 24 new highs this year in the S&P 500, and that also includes, that was from David Rosenberg. We're going to hit something that Rosie put in his note earlier today. So when you look at the S&P 500, let's move that cursor around. Let's go to that breakout level from the February 19th, and that brings us all the way back to, I think it was early June when we kind of broke out. You mentioned the VIX guy. I mean, look at how we're just kind of ticking higher and higher in the S&P 500. You have a VIX that, I'm hard pressed to think that it gets too much below those recent lows, especially despite the fact that the S&P keeps making highs, because, and CC had a great article that he kind of linked to in the newsletter, just talking about under the surface, we're seeing a lot of single stock volatility, and we've been highlighting that, right? And so, maybe there's some vol suppression trades that are going on in the market, and that's one of the things that this article kind of spoke to. But at some point, you're going to get a 5% pullback. Maybe there's a little fear put in it. Maybe you have a VIX that's above 20, and maybe that's really not that important, because maybe a lot of market participants who are seeing the market squeeze into quarter end would be happy for an opportunity to reload on some of their favorite names, and banks could be some of those and the like here. But when you see this sort of new highs every day, guy, this little grind that we're getting, it doesn't make me feel particularly bullish.
No, but I agree with everything you just said, and maybe that pullback is long overdue, and it will be a healthy reminder of things that are supposed to happen in normal markets. But I think what April did, at least my view, is it made people, the investing community and the trading community at large, feel impervious to whatever downdrafts we have. And I think what that told you is people have learned that, hey, you know what, these downdrafts are going to be short-lived, and you have to buy everything at sight once it happens. And I think that's one of the reasons we're not seeing some of these sell-offs, and that's why we're seeing tapered volatility because, again, people feel bulletproof right now, and maybe that's the right way to be. Maybe we are in an era where it's lower left, upper right, only to be sort of taken off the rails once or twice a year. I don't think that's the case. As I've said a number of times, some of these valuation metrics are at historic levels, and when I say historic, I mean historic, and I do think the market's in store for something. But, it doesn't matter what I think, because with each passing day, you have days where the grind sort of continues regardless of the news cycle, which, in large part, I think has been, at least historically, should have been detrimental to the market.
Yeah, and this is something, guy, it's right in your wheelhouse. David
I love
Rosenberg.
wheelhouse.
I know you do. David Rosenberg was writing about it in his early morning with Dave this morning. Doug Cass at streetpro.com has been talking about this. So this is investment grade spreads. And this it really does fall into, from a sentiment standpoint, what you just kind of discussed here. So IG spreads continue to tighten. The spread between investment grade corporates and treasuries has narrowed to less than 80 basis points, the tightest it has been since 1998. Barron's runs with a fascinating article that we will link to titled "Move Over Treasuries. There are the new safe assets, and these new assets are high-rated corporate bonds." This thesis deserves some merit when you consider that the government debt to GDP ratio is at record levels in excess of 120%, at the same time that the debt to equity ratio in the non-financial business sector has fallen from 19.2% a year ago to 17.3% currently, which is an all-time low. Speak to me.
Well, it speaks to, some of the things that Doug Cass has been talking about. The risk profile of the market right now is flashing red. And you see this debt to GDP is something we've talked about for a while, but the market in its rise is taking these things to levels that don't make sense. And when you start comparing things to 1998, 1999, I think we know sort of the corollary there. And it's nothing people want to hear because the market continues to go higher. It's something that people will talk about in the aftermath if something were to happen. I mean, it's just as simple as that. So people like me, Rosie, Doug, you can opine on these things, but as long as the market goes higher, people really don't want to hear it. And if they hear it, they'll completely dismiss it, saying it's different this time.
Yeah. So thinking about something that was going higher in anticipation of rate cuts, let's go to the home builders for a second. We know that KBH, I think, reports on Wednesday. We saw Lennar last week that missed. And, some of the things that they were speaking to because of the misses seemed contrary to, like what's gone on with the 30-year fix. It's come down from 685 to, I think it was 615 last week. I don't know where it is right now. It's probably ticked up a little bit, Guy. But, you see this is the ITB. This is the one that you like better, right? The home construction, the XHB has a bunch of retail, but some of the retail related to home building hasn't been particularly great. But you see that sort of really nice uptrend that has been in place, I want to say, since early summer. So here we are. We just kind of broke below it. You have that 200-day moving average that's been trending lower or so. Maybe they can flash up this Lennar chart. This thing was just a disaster. It broke down below 120, got down. I know it was down about 20 or so percent, and then had that, that rally back. Here it is. It bounced off that 200-day moving average, but not a great looking chart either. Thoughts here on these home builders?
Well, so let's talk about the home builders, because I think it's important. I think people underestimate the importance of like the entire home building sector to the overall economy, and that's a shorter term chart. But let's go back and look into the fall of last year, and you can see, and all these home builders to a certain extent look alike. But as I mentioned, you saw that huge run up into September and the subsequent sell-off. In the case of Lennar, you see the subsequent bounce, not nearly to the extent of some of the other home builders. For example, Toll Brothers, TOL, probably had a bigger bounce on a percentage basis. But again, they all look very similar. But I think what's happening here, in my opinion, is the market ran these up into anticipated rate cuts, got their rate cuts, and now they're selling them off. And by the way, the employment picture is a little bit different this time. Now, if you remember, the rate cut last year was on the back of some job concern, I think employment fears, which they were probably right to sort of talk about. But now those fears are coming to fruition. So now you have potential for higher longer-term rates, which is something we've talked about, and a weaker employment picture, none of which is bullish for the home builders, Dan. And I think that's the reason these stocks are selling off. But I do think it's a bit of a cautionary tale.
Yeah, no doubt. We'll keep a close eye on that. You mentioned, Guy, the market is up because it is what again? I can't
Open.
remember. Okay, so some of the drivers here, and I think this is worth noting. Apple is up on the year now. It's up nearly 4% on the day. It had a day yesterday, so it was rallying into the yesterday, meaning Friday. Into the launch of these new iPhones. And listen, this is one I've been wrong on these last few months on price. I find that the expectations for a upgrade super cycle on the hardware, maybe you're just seeing an upgrade cycle because of so many phones that I think there's hundreds of millions that are at least 3 or 4 years old, that sort of thing. And next year is going to be the 20th anniversary. I know that you've been pining away. 20th anniversary, if we make it to January of 2026, Guy.
That's a long time, Dan. That's not good. Oh,
Yeah.
by the way, I'm sorry to. Why
Yeah.
I can't believe it took me so long.
Yeah.
Since you're mentioning anniversaries on Friday, I know you don't watch CNBC's Fast Money, but we wish you a happy birthday. And Saturday was Dan's birthday.
Thank
We
you.
called him bright and early Saturday morning to wake his ass up. So
you know what's funny? It was 8:06 and I was sleeping, by the way. You did wake me up.
well, I waited till after 8.
And I know, but then I literally, I was like, all right, I got to get up. And I got up and then I went and had coffee and I called you back and it's you and Linda. You guys there are few people, and I mean this so sincerely, that are as genuinely, you are Johnny on the spot with people's birthdays and anniversaries. You call my parents on their, you are a sweet, sweet man, whether people think that you are or not, whether they think that. See, look at that. You are a very, very generous man when it comes to that sort of stuff, or most things, by the way. So thank you, Guy. That was very sweet of you. And I got a lot of texts from people that I know are Fast Money viewers or emails, and I figured something happened. But so thank you on that. I had a great weekend. So the stuff that's driving the gains, and they're not huge gains in the broad market, Guy, are just mega cap tech, right? So we mentioned Apple up in the year finally. Tesla last week, I think early last week or late the week before, went up on the year. Now it's up nearly 10%. It's also trading up nearly 4%. So it is interesting. We've been talking about this rotation within the Fateful Eight, Guy. And so you're starting to see it a little bit. Microsoft stalled out. Amazon didn't make a new high. Obviously, Google went higher. Meta has been kind of grinding a little bit. So as money went into Apple and Tesla, look at that. I mean, and Google, obviously, that was the one since they had the DOJ ruling. You could make the argument that you don't need all the Fateful Eight to be going at the same pace higher to keep a market higher, Guy.
You don't need that at all. You get a handful of them, you get a couple of them that are just treading water, and then, you're good to go. And I think that's what we're seeing now. As Apple was sort of languishing for the longest period of time, it was being picked up by some of the other names. And now that Apple's gotten off the mat, it's sort of taken the mantle back. And I think, we've been seeing this sort of push-pull between these 7, 8, 9 stocks for quite some time. And that's going to continue. I don't necessarily understand the Apple move either. I will tell you, like with many things, it's trading up to those prior all-time highs, which is either going to be, we're going to go blowing through it. And I think that was Dan, December 20th or something of last year when we traded up to 260, or we're going to fail. We'll see. But, this move, especially since, forget about since April, but just since the August low, I mean, that's a pretty big move for Apple in a pretty short period of time.
Yeah, and basically they announced that September 9th unveiling of the new phones, and then they, they take pre-orders the next Friday, and then they release them the next. Actually can get the phone. Make a 5-year this Apple really quickly, because one of the reasons for the underperformance is that, as we've seen, Microsoft and a handful of the Meta and a handful of other companies really benefit from the narrative around generative AI. It seemed like the more that they spent on CapEx, the higher the stocks would go. And one of the knocks on Apple is that they don't have a strategy. But for a while, people are like, hey, listen, maybe this is good for Apple. They're not spending tens of billions of dollars on developing their own large language model. And that's one of the things that, the stock's been stuck in the mud. We don't need to tell anybody about that. Once it kind of ticks that prior high, Guy, I think you kind of have to lay into it. Now, there is one thing I want to say, and you know that I'm a huge Apple product fan.
Sure you are.
Okay. I have iPhones, I have laptops, I have desktops, I have Apple TV, I have iPads.
You have the things in your ears.
I have the AirPods, that sort of thing. Okay, so I've had every Apple phone, and you could say, well, that's a little aggressive. And maybe the point is, if I'm talking about Apple every day on CNBC or on our podcast, I should probably know what's going on. And that's been part of it, but I also am a bit of a gadget freak. This phone, this is the iPhone Air. Okay, look at how thin this is. This is the best piece of Apple hardware that they have put out in over 10 years. So like I'm just telling you, it's a beautiful phone. It
Not the new
is,
one?
yeah, it's the brand new one. It's the
Wow.
Air, and it feels great. It feels sturdy. The one thing though that you're compromising here is battery and camera. So this will be interesting to see how folks kind of take to this sort of thing. The lead times for this phone, you can walk into a store and get it. That's not a great sort of thing, especially in this sort of environment where you know that supply chains have been kind of messed up a little bit because of tariffs. And supposedly the higher end phone, the highest end phone guy is $1,500. Like, think about that. $1,500. That's more expensive than their laptops. You know what I mean? So, they've got something going on. If they ever hit that Apple Intelligence the right way, and people are already conditioned to pay that much for the hardware, and they can get service revenues accelerating because of this AI built into the phone, then this thing is going to work. I mean,
Yeah.
like make no mistake about it. I'm just telling you, and margins have been going higher because of the mix shift. So if you have hardware margins that can go higher with services, then you got this thing going. I'm just saying.
Listen, and margins had been flatlining for a while. They're starting to tick up in the right direction for the first time in a long time. But here at 255, you're talking about a stock that's trading at 31 times next year. You have in front of you 31 times next year's numbers. Probably have high single-digit revenue growth, high single-digit EPS growth. I mean, it's trading like a growth stock. And I don't, I just throw it out there. I don't think I think the growth years are behind them. That's not me being derogatory in any way. I just think that's factually true. But yet they're being rewarded these kinds of valuations.
Yeah, and I guess when investors see how this company harnesses generative AI across their different platforms, iOS has nearly, I think, 1.75, billion users on their platform. Like, they're going to have to articulate, but this is a company that has only been iterating. I highlight this piece of hardware and this iPhone because it is literally the first interesting iPhone, really changed to the form factor and the way it works with the iOS since the iPhone 10. And I know that, to you, that was a big, that was a watershed moment for you.
Sure.
But next year, it's going to be the 20th anniversary, and they're expected to come out with a bunch of stuff.
I don't mean to interrupt. I don't. I
Go ahead.
put one of these, what do they call these things on my phone?
You call it I don't know, a case. You call
case.
it
You don't have a case on your phone? Because
I never
doesn't
have.
it feel very delicate? Like
No, that's the point. That's the point. If this is a beautiful piece of hardware, it's got titanium, it's got great glass. I want to feel it in my hand. You'll feel it later today when we show up the NASDAQ for the. All right, so
hold on. We gotta address this. This is from, by the way, Wavy McFly. I love Wavy. This is from SM 2022. Guy Dan, please name 3 stocks or sectors you're currently bullish on. Now, the impetus for this, by the way, go Raiders, man. Pete Carroll's Oakland Raiders or Las Vegas, wherever they're from now.
Sure.
Well, look, and again, I started this by saying, being bearish has been wrong. I mean, it's just that simple, and that's something that I've been for quite some time. I'm not going to run away from that. There have been places we've been bullish. I mean, a number of stocks, if you go and look, for example, I think since the beginning of the year, we thought Uber could trade triple digits. I think it traded there today. I think we've done a good job on a lot of these Chinese stocks. I think we've done a good job on some of these mining stocks. Dan Nathan, a couple Thursdays ago, when I think Tesla was trading in the 380s, thought you could see a bearish to bullish reversal. You see what's happening there. You talked about it on both shows. So I mean, there are other things as well. I mean, some energy stocks, Valero, for example. We've mentioned the crack spreads, how well the crack spreads have been trading in terms of what it means for the refiners. And Valero's trading to levels we last saw probably in the spring of this year, or spring of last year, excuse me. So I don't know. I don't like to take a lot of time talking about some of the few things we got right. I like talking about, some of the things we've been wrong about and why those things are. So
well, the Tesla is an interesting one. So the stock was trading like 355, and we started talking about it. I mentioned it on a podcast with actually Dan Ives, and we mentioned it here. And like if you want to just move it over to the right and just kind of like you see that first big update, like just move the chart so you can't see. No, the other way. Just move it the other way so you get rid of all that crap. Well, whatever. I mean, the upshot of it is like my view very simply was that sentiment was very negative, and that the likelihood, because they're getting rid of those tax credits at the end of this month, was that you're going to see upside to the delivery numbers. And the market's pricing that in right now. The stock went up, from 350 in a straight line to almost 450. And so you got to get to the end of next week. Maybe they continue to run this sort of thing. Consensus for deliveries is still way low of probably what they come into. But the time that they actually, maybe it's October 2nd or 3rd, when they release them, the stock can't go higher unless they're going to give some crazy sort of guidance, which they generally don't do when they release. But you can't put anything out of the ordinary when it comes to Elon and what they might guide to. So pretty soon I think you got to pull the ripcord. 350 just looked like a bit of a level there, and it's gone parabolic. But your point is like, okay, we have as many losers as we do winners. We're not kind of keeping score like that. What we're trying to do is just kind of give our 2 cents about what's going on, whether it be on a micro level, whether it be on a macro level, whether it be on a risk management level. So all that stuff. Here's one guy I just want to highlight a little bit because there's been few stocks in the market that have been as newsy as Oracle over the last few weeks.
Yeah.
So let's just pull this up. So it started out with some of the contracts go back to late January with Stargate. It was Masa of SoftBank. It was Sam Altman of OpenAI. They were talking about a $500 billion investment they're going to be making. They're going to create this thing called Stargate. Elon Musk immediately tweets out they don't have the money. Over the last few months, we've seen some of these contracts, big and small, that sort of thing. The OpenAI contract was the one that sent this stock going up as high as, what did it get up to? I don't know.
Oracle 350 something.
350. So it came back in. I am still of the belief that the company or the stock is going to fill in that gap at some point. They don't have the money to build out the infrastructure for all of these deals that they're getting. And, it's AI. Today it's Meta. It was Google, or not Google, but it was somebody else, a few weeks ago. So this is one where it's already priced in all that potential revenue upside, and they're going to have to spend. They've already started to guide up CapEx, I think last quarter from 25 to 35 billion. Some of their competitors are spending, gobs more a year than these guys are. And actually that was for the year, 25 billion to 35 billion.
So I stand corrected, 345, but point well taken. And, now, look, I will say this as well. For the longest time, I mean, we mentioned Oracle and sort of the old tech world and how this could absolutely surprise some people, and that proved to be correct. If I'm being honest, in my wildest dreams, I never thought we'd get to levels that we're trading at now. It's effectively a $1 trillion company. And one of the reasons I liked Oracle for such a long time is the valuation made a lot of sense, and they seemingly were in the right businesses. Yeah, they've been rolling up companies. It's an M&A strategy thing, but those M&A strategies seem to be paying off for them. But now, as quickly as it got itself, as quickly as it was a cheap stock on valuation, it's become an expensive stock. And I know a lot of analysts are tripping over themselves, raising their price targets, but you really have to be betting on a lot of things. And this revenue that they talked about, I think a week or so ago, or maybe a week and a half or so ago, while I was in Italy, all this revenue that they were going to get on the back of all these specific deals, we don't know what the earnings on that revenue is going to be. So it's great to have the revenue, but you have to understand what the earnings on the back of it is going to be.
Yeah. Tomorrow, we're going to have a trade idea here, and it's going to be something targeting, you ready for this guy? 330, 265, and maybe all the way down to like 210. It's going to be a butterfly strategy. We're going to
like that
here, and we're going to kind of walk through how one might put that on and what the kind of defined risk scenario is and what the outcomes you're looking for. So that will be in Oracle. I want to hit you on this. So, Robinhood, great partner of ours. We're not going to really talk about the stock. The stock's been a monster. It's over $100 billion market cap today. I think it's trading very near an all-time high. Maybe let's just pull that up for a second. And we were at the Robinhood Summit a couple of weeks ago. Very impressive. Some of the products that they are releasing, and we've been highlighting some of those on the market call here. So that is what it is. $110 billion market cap. This is something that, from a multiple standpoint, it's something that people are going to continue to talk about. Is something that makes not a lot of sense. I want to pull up IBKR. So this is the Interactive Brokers. So this is a competitor. I think they compete on a very different sort of level than like a retail client like Robinhood. But Guy, this one has consolidated here, and I want to talk about valuation. I want to talk about growth, but you see that kind of breakout level going back to February, and then you can look at it in late June or something like that. It's consolidated here. This is also about $110 billion market cap company. And now I want to pull up Schwab for a second. Okay. And so Schwab is about 175 billion, but Schwab is one that sticks out to me, Guy, like a sore thumb from a valuation standpoint. So I just want to kind of run you through this for a second. Okay. So Schwab this year, and there's not much of this year left, is expected to grow earnings, 43%. And that's off a low base last year. I mean, the stock earnings had been going sideways for a bit. Trades about 20 times, this year. Next year, expected to have 17% EPS growth, trades at 17 times. Revenue growth for this year, 20%, 10% for next. So on a PE to growth for next year, trades at a peg of 1. Mm-hmm. Okay. Now I just want to throw in IBKR. All right. So if I look at Interactive Brokers, this year expected earnings growth of 11%, or 15%, 8% next year. Revenue growth expected this year of 11%, 7% next year. It trades at 31.5 times this year and 29 times next. Okay. Again, I just said EPS growth of 18% next year. To me, this seems like a glaringly obvious valuation trade. Both stocks have performed very similar. Both stocks are kind of stuck in the mud. Thoughts here, Guy?
I think, you're pointing out that Schwab is cheap in comparison to its rivals. But remember in 2023, how poorly Schwab was trading and the interest rate environment and the regional bank crisis. And I think one of the reasons why it's had a great move since then. It's probably doubled since those lows we saw in 2023 or close to it. But I think one of the reasons it trades at a discount is the overhang of those concerns that were out there during the regional bank crisis in 2020. It was 2023, right? I'm getting my years straight. So
March 23.
I think that's, to me, that's what's going on. Now, you'll say at some point it's going to be rewarded in terms of the valuations that some of these other companies see, and maybe that's the case. But I think that's what's going on. I think there's still that overhang from a couple of years ago. Just my opinion.
Yeah, but Guy, I think IBKR had some of the same. But here's you got to think. Make this a 5-year chart. So you would think that IBKR, at the same time of March of 23, when ChatGPT 4 was out there, that these guys did the same thing. They developed an LLM that was going to change, and pull up Schwab here for a second. It is pretty astounding. And I just think it's important to recognize because, Schwab, oh, look at that. I mean, that's that double top. Oof, that's not pretty. Go back to IBKR for a second, Guy. So this is one. It's kind of interesting. We just mentioned earnings and what they've been doing. So in 23, when the stock was getting nailed, this company had $1.44 in earnings. The next year they had $1.76. 2025, this year expected to be $2.02, and then only $2.18. I mean, this is a company that's not growing earnings. And look at the volatility bands, how they've been widening. And look at the parabolic nature, first in the run up to February, then obviously the April lows. And here, I mean, does that expected earnings growth warrant that sort of price action?
No, I don't think so. But I think it's probably piggybacking on the back of what Robinhood has done. I think this is sort of a rising tide type of situation that's bringing all boats higher. But I don't think it makes a lot of sense. I also think, and I don't know it exactly right, but I also think they're into some other sort of exotic plays that the market is probably rewarding them for as well, in terms of some of these predictive markets as well. So that's what's going on there. Real quick before we get out of here, Bogdan Bo-Casso, that's fantastic, by the way. He's talking about the gold GDX, GLD. Look, I don't know what to tell you, brother. Bo, I love that. But man, oh man, it still works. And even when the market goes up, market goes down, rates go up, rates go down, gold continues to sort of rock. And look at gold today. I mean, it's having a day on the back of you tell me what, because it's open, I guess. So gold is trying to tell a story. I think you stay with it. And then the last thing for me is Disney. What are your thoughts? Obviously, in the news recently, that 123 level's been resistance a number of times. I think it's sort of no man's land here, Dan, and for no reasons other than, technically it can't get through those prior highs. You go all the way back to the spring of 2024, and that 123 level's been a problem.
Doug Cass had a note out on the Street Pro this morning. I thought it was really interesting. I mean, you and I have been thinking about Disney. We've been talking about Disney since all the stuff with Kimmel last week. And, listen, you see these sorts of things where people are like boycotting this or that or whatever. Doug's point had nothing to do with any of that. It had to do with the theme parks and the cost of admission and the cost of, lodging there, and really what we're seeing with the consumer and what we're seeing with the weakening job market. And so theme parks have been great. Oddly great for them over the last year and a half or so. So that's probably something worth paying more attention to. Last thing before we get out of here, I want to pull up Bitcoin.
Yeah.
And, we've been highlighting this divergence between gold, which you've been all over, and Bitcoin. And, the information had an article out, and I've been talking about this. I've been thinking about it. I've been talking on our podcast, is like all of this excitement. Let's go back a year and a half, 2 years ago. It was ETFs, right? Then there was excitement about legislation. And then it was the excitement about stable coins. And then it's been the excitement around these treasury vehicles, right? Where equity companies are, selling debt, equity, everything they can that's not bolting down. And they're buying, whether it's ETH or Bitcoin or this, whatever, and they're getting leverage on it. All of those things together. And the fact that we're kind of stalled out here, and you may say, if you're a Bitcoin bull, you love it, okay? Because all that stuff's going to be a massive tailwind. And this is just a consolidation before we go higher. And just look at that chart. You see it. You have these legs up. You have these consolidations. Then you go higher. What's different this time, possibly, Guy, is that you have the confluence of all of these sorts of things at one time, and you can't get crypto going higher, at least Bitcoin right here. If there are any hiccups, you know what I mean? Like, this seems like it's a levered disaster waiting to happen. And the stable coin one, maybe not yet, because we don't have them that embedded into the financial system, but there could be an issue somewhere else outside the US. And so that, to me, I just find this crypto thing right here, right now, as really an interesting, it seems like there's more risk to it, Guy, than there is potential upside.
You brought that up a couple times. I think most recently with Stuart Sopp, the CEO and co-founder of Current, some of the concerns you had around exactly that. And I think Stuart probably shared it, but probably not to the extent that you have feelings. But I agree. I think this is just a leverage bomb potentially waiting to happen. And I don't pretend to really understand Bitcoin. It's not my jam. But I will tell you, with all the good news and each day seemingly parading out more and more people talking about how Bitcoin's going to be 300,000 by the end of the year, 1 million by the end, and it still sort of can't get out of its own way, despite the fact that the Fed is being somewhat accommodative now. And I think those should be some warning signs in terms of the lack of recent performance in Bitcoin.
Well, here's one other thing. And look at all these IPOs we had. We had Circle, we had Bullish, we had Figure, we had Gemini, and none of them are trading that well. Definitely off the highs. Gemini has traded. Maybe they could pull up this one. Was it GEMI? I have no idea. It's called Gemi Space Station. Like, I don't know what the hell's going on there, but this thing already broke price. Pull up BLSH. Had a huge first couple days, but has come back. No, is that it? It's
Bullish
down.
Is BLSH, yes. It's trading 65. I think it got up to like 120 or something.
Okay, but that chart doesn't show that. So whatever's going on,
it's a recent, it's
but just give us, okay. So you see that in the Circle, but these are also competition for Bitcoin, right? So people are playing these. There's only so much amount of dollars. Go to Coinbase really quickly. So I just think that all this issuance is interesting. I don't know what we're doing here with the chart. Yeah, there we go. So I just think this thing's kind of stuck in the mud. Too. The last thing I'm going to say is, as we get into the midterms, okay, and it's a ways away. I get it. There might be a really interesting trade to track if you're tracking the prediction markets and all this sort of stuff. You might see, Bitcoin go one way or the other, as it looks like, maybe you see the Dems take the House back, or you know what I mean, stuff like that. Then a lot of this legislation, a lot of the excitement around some of these meme coins and stable coins, it may go the other way. So, and by the way, if it looks like the Dems don't have a chance, you know what I mean, then you could see Bitcoin maybe go to 200 or whatever. I'm just highlighting that could be a really interesting trade next year.
Well, stay tuned, because it's going to come up a lot faster than people realize. So I think, look, I mean, but as we close out here, I'll highlight a couple things. The fact that the market is basically flat on the day. You have a VIX that's pushing up against 16. We're going to talk about the Russell a little bit tomorrow in terms of the IWM and the bond market. I sound like a broken friggin' record here, but rates are going to continue to be a story, and that's something I'm going to watch as well as we get towards closer to the close, Dan Nathan.
All right. Well, listen, guys, sounds like you're playing hurt. I know you will not.
No,
acknowledge it. Maybe you get some of that Jewish penicillin. Bill and I just ordered some matzo ball soup from our favorite.
Bill, by the way?
He's doing fine. Just like Amanda is doing fine. You know what I mean?
Amanda's great.
Amanda's doing great.
Where is it?
Oh my God. We had the delivery guy said the FUD is in the LOVVY, which I know there's a lot of typos there, but Bill and I have
the FUD. Oh, food.
The food is in the lobby. So
Bill can use that in his routine. See, every day
we're dying over here. Bill and I have been laughing about that for 15 minutes.
I saw something funny with Bill, and
I saw something interesting today.
I saw something interesting. Bill has him and his buddy do these little like Instagram podcast things. Yeah. And his buddy said to him, the setup for that joke was so boring. Bill, you know what I'm talking about?
Yeah, he's laughing. He knows. He's talking about Bill's setup of a joke.
Yeah,
so you know what you want to do? Show of hands. That's a good setup for a joke. Show of hands, right? Guy has been lobbying Billy Hockman. You go follow him on the Instagram, people. He's actually very funny, despite what his buddy said about with a setup of a joke.
Well, no, this time his buddy was right. The setup was effing brutal. I mean,
but Guy wants him to start a new bit at the Greenwich Comedy Club. What do you want him to do, Guy?
You walk in and say, look, show of hands. Who doesn't want to be here tonight? Who got dragged here by their significant other? I mean, that's funny shit.
Yeah, but he doesn't love what they call crowd work, Guy, because he thinks
he doesn't like crowd work.
Yeah, so that would fall into the crowd. But I've seen him a couple times, and every once in a while he'll do a little.
I love crowd work. See, I embrace the crowd work.
I know you do. Well, that's your jam. When we do Fast Money Live, they send you into the crowd. Like that's the thing that you do. But Bill, every once in a while, look down and they'll say, "Oh, you guys together?" And the people are like, "No." And then all of a sudden it gets awkward, and they're literally in the club alone. These people, they just wandered in on McDougal Street, and they're like, I want to go to a comedy club. And then they happen to be sitting with somebody. It could be two women, it could be two guys, it could be a girl and a guy, it could be whatever. This is where we live these days. It's like, have a ball. And they're like looking at each other like, no, I don't know this person I'm sitting next to.
That makes for a difficult routine. That's, what do they call that? The kids say that's awk.
Bill says awk. No, but he powers through it, and he's
a pro.
He's not one of these guys who makes fun of people. He's not trying to get laughs at the expense of people, we'll just leave it at that. Billy Hockman.
Billy Hockman, ladies and gentlemen.
All right, everyone. We'll see you tomorrow. Bye-bye.